Hello, everyone, and welcome to the final episode of Steelmint Events Engage webinar series. The topic for today is titled Changing Dynamics of Global Met Coke Trade. With us is Mr. Vigneshwaran K, Chief Marketing Officer, Coke Business at Vedanta. Mr. Vigneshwaran has 11 plus years of experience in marketing variety of steelmaking raw materials like iron ore, coke, pig iron, etc., in both domestic and international markets. He's presently heading the marketing function of India's largest merchant met coke facility of 1 million ton per annum capacity. Good afternoon, Mr. Vigneshwaram, to you, and welcome to our webinar.
Very good evening, Rohan. Thanks a lot for the brief introduction.
A warm welcome also to all the participants who have joined us for this webinar. You can send us your questions in the Q&A box, which is appearing on your screen. And do remember to mention your name and your companies. So without further ado, I'll request Mr. Vigneshwaram to share his presentation with us, post which we would like to ask him a few questions. Over to you, Mr. Vigneshwaram.
Yeah, thanks, Rohan. And thanks everyone on the call for taking out your time and then joining this session. Especially it's a privilege to, be a last speaker in the series of the webinar. But also I was little, thinking about being a weekend and people would be, prioritizing their jobs and then, getting ready to leave. So I'm very, very thankful for the audience joined in for taking out time and joining in this webinar. Let me share my screen. Is my screen visible, Rohan?
Yeah, it's clearly visible.
Yeah. So before going into the topic, I would like to give a brief introduction about the company as well. So Vedanta is one of the largest diversified natural resources company in the world, involved in production of zinc, silver, lead, aluminum, copper, power, oil and gas, iron ore, steel, pig and ferroalloys, and now we are also into merchant coke. And to name a few countries, we have operations across India, South Africa, Namibia, and Australia. And regarding the met coke facilities, right now the overall capacity is about 1.7 million tons in the installed capacity, with the addition of the Gujarat facilities, which is the recent acquisition, in addition to our existing facilities in the state of Goa and Maharashtra. So out of this 1.7, roughly about 1.1 million tons would be for merchant sales. And we have 2 decades of presence in the met coke market with the patented our technology. So this is about the brief about the business. Now I'll go into the topic. Indeed, a most interesting topic in today's market scenario, that changing dynamics of global met coke trade. So before going into the met coke trade dynamics and then further analysis and my viewpoint, I would like to start with giving a brief overview of steel and the met coal, and then further into the met coke. I know, in this series of webinars, eminent speakers have talked a lot about the steel, global Indian steel, and of course the met coal as well. But this is only a high level, summary and my takes and viewpoints, what I would like to share with the audience. So overall, if you see about the steel production globally is about 1.8 billion tons. And this steel is made using 2 billion tons of iron ore and 1 billion tons of coking coal. And also around 600 to 700 million tons of recycled steel scrap is also used. But these are the primary raw materials for making this steel of 1.8 billion tons. And in terms of the trade value, if we see this steel, met coal, and then iron ore, all three putting together is the second largest next to the oil in terms of the trade value. In fact, it is more than 50% of the oil's trade value. So if we say like oil is controlling the economy, then of course, steel and the steel making raw materials also are important drivers of the growth and economy of countries. And now when I'm next, I'm going to the 1 minute. Yeah. This is about the overall view of the met coal international trade. So basically about 350 million tons of met coal is internationally traded. So it is about 32%. And out of which, if you say like 90% of this trade is seaborne, hardly about say 35 maybe 40 million tons of coal is traded through the road. Basically, it is Mongolia. It can be as good as considered as a captive met coal trade for China. So in this overall seaborne trade, if you see 60% of the supply is from one country, that is Australia. And then on the demand side, if you see 40% India and China together, about say 140, 135 to 140 million tons is actually the demand from these two countries, China and India. So overall, we can say within these three countries, like the major drivers of demand supply imbalance, or maybe whatever we call it, that the controlled by these three major countries. And whatever scenario today is also, we all of us know what is happening. Like China stopped buying from Australia, and and India started buying more because our steel production is increasing. So that way, all these imbalances created the short up of the prices in the recent times. So now I will move to the met coke trade. So roughly 750 million tons of met coke is required to make the steel of say whatever we have discussed, about 1.8 million tons, out of which around maybe 1.2 million tons or 70% or so is produced through the blast furnace route. On this, if we see the captive and the trade, if you see, like the captive and non-seaborne, that is domestic coke, basically it is captive, that 97% of the volume, basically predominantly it is of captive, and only 3% is the seaborne trades which are happening, which is about say 25 million tons. Because coke being a commodity which while transporting, like the quality will be at risk, so generally the steel plants prefer having their own captive plants. So that is how this ratio of 97 and 3%. So now out of this 3% of seaborne trade, if we see who are the major exporters and importers, uh, the major exporters are like China, Poland, Russia, Colombia, and these four countries are almost 75% of the entire market. And this I am talking about at the ideal conditions, not now. I will be covering what has happened. Maybe you can say post COVID, or maybe after the recent imbalance in the demand supply, that China stopped supplying and then started importing. I'll cover that later. But this is the scenario which was prevailing before. So if we see about, meaning these four countries, China, Poland, Russia, and Colombia, were about 75% of the supply. But again, in terms of the importers, if you see of met coke as a single country, yes, of course, India was the largest, and European Union was 20%, and then followed by other countries like Malaysia, Brazil, Vietnam, Turkey, Japan, Canada, Mexico, ranging from 4 to 6%. So now in the recent development, what happened, we all know that there was an issue of the coking coal, that China stopped buying from Australia, and then Australia started supplying in the non-traditional market. China also started buying from the like US, Canada, and Russia, and all those stuff. So that's how the prices started increasing. And also with respect to the production cuts in China, the production cuts were actually even for not only for steel and also for the met coke, due to the environmental conditions or maybe restrictions there. So that way, what happened was China, this 25% of the export share has become 16%, almost 10% reductions in the export volume from China. About 6 million tons is what they used to export. And now this year they've supplied about 4 million tons. But again, going forward, we have to see whether this material is going to come to market at all. And in addition to that, the 2% what the minuscule value which China was importing has become now 6%, a threefold increase. So all in all, 10% on the export side and about 4% on the import side. making an impact of total 13 to 14% overall. And now what has happened was like, obviously when there is a void, there will be somebody who is entering and then filling up in the void. But as a surprise, India started, filling up the void. Of course, with Poland, but Poland also we know that they have been supplying and they are also an important exporter of met coke. But the surprise was obviously India, because India was the largest importer of met coke, and roughly like Poland was like 4% more, like they are now up to 29%. So this void is being filled by India and Poland partially. However, what we are seeing is like the imports of India continues to remain stable. Like we will further discuss on this, like what is the dynamics now. This is very clear, like now India has a very good opportunity which is already understood, and then India started now becoming very, very active in the export market. So now I would like to further discuss more on the Indian market in specific. Having said all this now, that overall India's demand is about 40 million tons of met coke, out of which 35 million tons is again captive and 5 million tons is the merchant. This 5 million tons, like around 3 million ton is actually sold by the import. It is made by imports, and this remaining 2 million tons is made by the domestic supply. But now what we are actually witnessing, the exports from India, which is about maybe as we speak now, we'll be touching 1 million tons of export in India. So that is also happening from the domestic producers without disturbing this 2 million tons, because as we all know that the steel production in India is actually good. In fact, we have made about 87 million tons of steel up to September in this calendar year, and we are now going towards probably 116 or maybe 120. So this 2 million tons also remain, but again that further addition of about 1 million tons is now made available for the export market from the existing facilities. So now if you talk about the capacities of total coke, meaning cokeries in India, the total capacity is about 6 million tons. So out of which almost 1/3 of the capacity was being utilized. That's how the domestic coke availability was about 2 million tons historically. But now we have seen that it has already gone up to 3 million tons in the form of exports, and then further 1 million tons it is going to go up, and that is going to be from Vedanta. So 4 million ton is going to happen from the existing capacities. So from 6 million tons of the existing capacity. So that is very clear now. So all in all, like what is happening with India, when one side I said like exports are increasing, and the other side the imports continue to remain stable. So the export is about say 1 million tons, and maybe we will be exiting this calendar year with maybe about 1.2 or 1.3 million tons of export. And the destinations of exports are like Italy, Vietnam, Brazil, Indonesia, and these 4 countries account for about 70% of the exports from India. On the import side, as I said, the imports are stable despite idle capacities, what we discussed in the previous slide, and also increased exports. These imports continue to remain stable. So which looks like like long-term contracts of import is of course a particular share. Apart from that, despite the high international prices, like the steel companies are still preferring imports, which I would like to say that the Indian coke producers have to focus more on the quality. And what is our observation is that the capacities are maybe 6 million tons, but again if you see the number of players are actually very high. It is a highly fragmented market, I would say. An individual plant's capacity varies, starts from even as low as 45,000 tons per annum. So that way, we need to really see how best quality products are produced from those units, how we can stabilize on the quality part. And all these units are very small in size, whether they are able to deliver, whether they are able to accommodate the global dynamics, because like coke is a product which is dependent on 100% imported coking coal. So you need to have that much financial capacity also. So all these things have to be seen, like like the quality, and then the timely delivery, how efficient these people are to produce. So those are the points we need to discuss. And these imports, as I said, like imports are from majorly from 3 countries, which are accounting to about 70%, like Poland, Colombia, and Japan. And maybe Poland is on long-term contract, and remaining are from the spot deals. But the purpose or the point I would like to make here is that imports are still happening. Right? So what are the now key takeaways now from whatever we have discussed? That of course there is an opportunity for Indian coke producers to fill the void on the seaborne market, which we have witnessed. And then this is again, there is further opportunities also going to be there, because in the near term we are not seeing any changes on the fundamentals. That the situation is going to be more or less similar, and it may further, even the void may increase also further. So there is a very clear-cut opportunity. And as far as the domestic demand is concerned, like we are very, very optimistic. India is going to be, phenomenal in terms of the growth or maybe steel production, because we have a target of 300 million tons by 2030. If not 300, at least we'll be crossing 200 to 250. So that way the demand is definitely going to increase in India. So as we discussed, like the quality and the delivery are the key focus areas for the Indian coke producers. The area of improvements, I would say, rather. And the organized players are now stepping in, because the market looks very, very lucrative, and there is a good potential in this market. As you all know, Vedanta has also stepped in now. And the FTA with Australia and the MOU with Russia in the long term may improve the coal availability. In the short term, I'm not seeing anything to drastically improve further, because Russia, what I remember, is about 40 million tons, but the MOU. But again, what they are currently supplying is 25, so it's going to take a long time. And again, your price and logistics, your freight cost, everything is going to play an important role. And lastly, like as I said, like these steel plants, when the capacities are increasing, generally the preference is to go for a captive coke ovens, so which are also steadily increasing, which you have seen, which might also happen in the future. So the merchant coke producers have to be cautious about this fact also. So this is about me. I actually wanted to make this session more interactive, listening to the questions, and then kind of a rather than dumping up with a lot of data, charts, and then trends. I wanted to make it so simple and and open for discussion. Now I am done with my presentation, Rohan. So we can go. If there are any questions, we can discuss.
Yeah. Thank you, sir, for your simple yet exhaustive presentation. Now let us proceed with our round of Q&A. The audience can also send in their questions in the Q&A box. We'll be taking that in a short while. So my first question to you is, Chinese domestic met coke prices have surged by more than 70% since the beginning of the year, and China has withdrawn from the export market. How much influence do you still see China have over coke prices and over global prices of met coke?
No, China does have the influence on the global met coke prices. Not only met coke, for that matter, it is all steel making raw materials. Because ultimately the demand is very high there, so they are going to be the influencer. So how much is something which I may not be able to quantify, but as long as the disparity exists, there is going to be the prices are going to remain at the elevated levels in the near term.
And how are steel production cuts amidst strict environmental norms impacting China's met coke industry? Are exports from China likely to resume soon, keeping this in mind?
Meaning you mean to say that steel production is now being cut, so there will be some surplus coke which will be available for exports? Is that your question?
That's my question, yeah.
Okay. So, see, what I see, the environmental norms are not only for steel. What we understand is also for the met coke. Even recently, I've heard that Shandong province, which supposed to produce about 46 million tons of coal, is being asked to produce about 30 million tons, and they have been asked to maintain the ratio of steel to coke zero point 0.4. So this the cuts what are happening in the steel is also happening in the met coke, which we have already witnessed also now. That's how the exports have stopped from China, and then China started importing. So I don't see any surplus availability of met coke, at least in the near future, from China.
No, but in the global scheme of things, would like imports by China reduce then?
Imports by China, see, import by China might reduce, but again, it is not very high, as we discussed. No, like if you see from 2%, they've gone up to 6%. So it is again 4%. As of now, it is not looking as it is not going to create any turbulence as such. But you'll never know. It might happen if suppose if they are stopping the imports. But imports are anyway at the moment it is hardly anything. It may not impact the market heavily. That is my perspective.
And how much do you see, how much is the influence of coking coal on met coke prices? Isn't that the primary reason why met coke prices are so high, because of coking coal prices? So
It
if
is.
demand for met coke reduces, there'd be some pressure on coking coal as well, right?
Yeah, of course. So no, it is actually a combination of both, I would say. So definitely the coking coal prices do have an impact on the met coke prices, because ultimately that is the one and only raw material. There is nothing else. But only thing, this margin part, maybe the shortage of the met coke overall, that China now is absent from the international market and started importing. Maybe that has created a little bit of an imbalance now. So that, supported by the higher coking coal prices, is what now leading to the inflated coke prices, I would say.
Right. And what is your anticipation or forecast for India delivered seaborne met coke prices,
Import prices.
port prices?
See, import prices, see now forecast, as in, I'm not sure. See, now even if you look at the coking coal prices now, because now that is the only raw material, as we said, about, see, $400 FOB Australia is the price now. So accordingly, if you see, so it should be around, at today's market scenario, it should be around, say, 700 to maybe $720. It should be the price, and that maybe this might last till end of this quarter at least.
Thank you. And do you see any increase in capacity in captive met coke production?
Captive met coke production, yes, of course, we see whoever is expanding, like I would say most of the players in India, whoever is having the expansion plans, actually they are having their own, captive coke own plants.
Right. And a lot of producers in the Dhanbad region became active with high margins in the met coke industry.
Yeah.
But the situation is not the same now with coking coal prices becoming so high. What do you see happening there? Do you see some production taken off?
Sorry, I missed your question. Can you please repeat?
Do you expect some production cuts there
In
for met?
Dhanbad?
Yeah.
No. Like, I missed the entire part of this thing.
Oh, okay. So I was saying that earlier there were healthy margins in met coke trade. So a
Yeah.
lot of players in Dhanbad region became active.
Yes.
But the situation has changed now with coking coal prices reaching to around $400.
See, Dhanbad region generally actually uses the local coal. Like they use very high ash content coal, basically, which is supplied from the Coal India. So that's why it is a different market altogether. Like it's not a low ash metallurgical coke. So now we are seeing the coal unavailability from Coal India. It's a a hot topic now. So maybe supply side there could be a problem. Otherwise, on the demand side, I don't see any issue. The demand is still very healthy, and now I would say even the production of maybe merchant and then the supplies are very cut to cut. I would not say there is a scarcity. People are reducing their steel production because of the met coke. There are sufficient supplies, but still the demand is very healthy. Maybe there could be another reason. I'm not sure for the Dhanbad region, because largely it was being supplied to the small MSMEs who were actually producing kind of small scale foundries and everything. Maybe the demand from that particular sector has come down, possibly.
And going forward, what is your outlook for met coke sourcing in India? Do you expect Indian met coke buyers to reduce imports amid high prices in favor of relatively cheaper material available from domestic merchant producers like Vedanta?
Meaning, you want Vedanta to sell cheaper?
No, as in like import versus domestic, there's still a gap.
Yeah. Yeah. So I was just making this thing, Rohan. I got your point. See, historically, also there was always been a gap. The domestic prices were lower compared to the international levels, which I mentioned about the quality part, about the quality of products. Of course, there are few players in India who are really making a good quality coke. I'm not saying the complete market is producing an low quality product. It is not that way. But again, the major share of it ultimately depends on the pricing. Somebody will not go to the export market and will buy at say $50-$60 extra. Just simply they will not do, because there is that disparity exists because of some reasons. So that's those reasons which I tried to little bit cover in the presentation, was basically the quality and the commitment of supplies. So that way that disparity was existing. But again, if you ask very specific to Vedanta, like we are going to produce a very world-class quality product, no doubt about it, because we have our brand Sasa Coke established, and in the market in India it is the best coke. So that way, at par, quality wise, we don't see any difference. And also it now we are now getting into, there are not going to any issue of supplies and everything. So as far as Vedanta is concerned, I don't think any disparity will exist. See, now again, this was the scenario, but now again when exports started increasing in India, even we have started seeing that disparity coming down. Like now it is at par. So that way I'm saying, see, it is ultimately it is mathematics. Like if somebody is getting at X price, and if somebody is getting at Y price from domestic India, that X minus Y delta, there is always a reason. Maybe the quality, or maybe the shortage, whatever it is. As long as that is going to be bridged, that gap is going to be filled, I don't think there will be any disparity on the pricing front.
Right. And, with exports rising from India, maybe there'll be lesser pressure on the merchant producers to sell in the domestic market as well.
That is also there, absolutely.
Yeah.
But so, what we are seeing is that the utilization levels have gone up. We were producing about 50-60% last year, are now producing up to 100%, and there are now addition of new capacities as well. But there is a supply tightness. I agree with you.
So do you see met coke exports from India continue to rise? Is this trend going to continue?
Looks like it will continue, because as long as the void is there, so somebody will have to fill in. So as far as now international market is concerned, I see a lot of idle capacities basically in India. But we'll have to see how the market is going to accept, whether these prices are going to be sustainable now on the long term. So there are n number of variables. But again, in the near term, I see this export from India is going to continue.
Right. Also, is there a possibility of production cuts in pig iron and ferroalloys industry due to rising coking coal and coke prices in India?
No, as long as the consumption is supporting, that is, still margins are supporting, I don't see there will be any production cuts. But at the moment, the market looks very bullish. The consumption is very high. That is a good demand. across commodity markets. So in the near term, I don't see any production cuts in pig iron or ferroalloys.
And India is exploring new markets for sourcing coking coal. India recently signed an MOU with Russia to collaborate in steel and mining sector with focus on coking coal. Will this result in lowering the production cost of met coke?
Lowering the production cost, I don't know, but again, it will increase the availability for the Indian producers, and it will be required because India's demand is going to go up. And but again, Russia will have to see whether Russia is going to be competitive for us, because one is now because of the dynamics, now Russia is supplying to China, and we know at what prices China is buying. But again, on long term, like if you are referring to the MOU that is signed and all, like, but it is going to take a lot of time, because 40 million tons now currently the country is producing about, or selling in the seaborne market about 25 million tons. If India alone is going to get 40 million tons from Russia, it is going to take time. But of course, it is going to increase the availability. It is going to help us. But again, cost of production, maybe the market has to decide. I'll not be able to comment as of now.
Yeah, I mean, why would Russia sell to India at a cheaper rate than China?
Of course. And China is buying now almost $180 higher than India. India, maybe we will get at 430. China is buying at 615 and 20 now. So.
Yeah, very right. I'll now like to go over to the viewers and take a few of their questions.
Please.
So we have one question for you. And the person's asked, what would be the future potential of met coke in domestic and export scenarios? Will the merchant market be affected negatively in any way?
No, it is definitely not going to be affected in a negative way. As I mentioned, the merchant market is going to do good. So that's what we see. That we discussed at length about the export from India that are going to continue for a while. And similarly, the domestic demand is also increasing. So that way, I don't see any threat for the merchant coke producers in the near term. Of course, in the long term, it is there, which I mentioned, like if the ISPs are now going for a captive plant. So that is always there.
Mm-hmm. So in the same vein, another person has asked, we are hearing of met coke producers stopping production due to cash flow issues and production cuts with higher coking coal prices. Do you see such a scenario shaping up?
Yeah, we did see such things, which is the reason I also mentioned. The size of the plants. The market is highly fragmented in India. I don't know how many number of plants are there. When you're totaling up that quantity, capacity into 6 million tons. As low as 45 KT, which we have seen in Gujarat. So that way, these players are very small. But again, see what happens is, MSMEs we have to encourage and all is actually in principle agreed. But again, when it comes to commodities, and a commodity which is more dependent on a commodity, meaning international commodity like coking coal, whether the small players will be able to accommodate the price variations is the question. So it's going to be very, very difficult for a small players. So we have seen such cases, yes.
Okay. I think that will be all, and we're almost out of time, stipulated time. And I'd like to thank our associate sponsors, NMDC, Tata Steel, Lumta Steel. I'd also like to thank the Indian Steel Association and Steel Users Federation of India for their valuable support. And mostly, I'd like to thank Vedanta Limited for giving us this opportunity to interact with Mr. Vigneshwaram and gain his valuable insights. Any final remarks from you, sir?
No, overall, I would like to express my gratitude for giving this opportunity to Stillmint, Coldmint, and especially Rohan, you and your team. The way you coordinated and then made it so smooth. So, and then I would like to also say that Steelmint as a group is doing a phenomenal job for the entire industry, making the information available so easily, and then conducting such seminars and taking lead on making awareness and making information available for the people. So I really appreciate, and the job what you all are doing is commendable. Please keep up the good work going. Keep it up, and thank you so much. And thank you so much for the participants of this um, webinar, taking out time